The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A pleasant surprise on CPI, reassuring earnings from the big banks, but stocks retreat nonetheless. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. And of course, the inflation report got things off on a good start, but we're not seeing it play out right now.
Not at all.
All right, let's take a look. The S&P 500 now down by 0.25%. That tame inflation report not helping too much. The story right now is that stocks have turned lower as the House procedural motion on those cyber measures have failed. We do see, however, semiconductor stocks led by NVIDIA and AMD rising because they will now be able to resume their sales of some AI chips to China. We are seeing a lot of activity in fixed income. Treasuries are falling with the short end underperforming longer maturities for a change. That inflation report indicating the Fed will likely stay on hold for longer, and big movements, at least in the Japanese 10-year yield. The 10-year yield at one point reached the highest since 2008. Some election tax cut pledges unnerving investors.
All right, let's go back to that CPI report, though, because it did prove to be a bit of a Rorschach test for markets. On one hand, headlines blaring about headline inflation rising month to month, 0.3%, the biggest increase since January. On the other hand, there were headlines blaring that core inflation, which strips out food and energy, rose less than expected for a fifth straight month. Both things certainly can be true. The problem is neither right now provides much clarity.
This uncertainty is the very thing that's making it impossible for the Federal Reserve to say that we're out of the woods or will be out of the woods on inflation.
Now, overall, most economists are still looking for the canary in the coal mine. Omer Sharif over at Inflation Insights, he says if you strip out autos, core goods inflation actually rose the most since 2021. And then you had that drop in airline fares and other leisure categories, suggesting consumers are indeed pushing back a bit from the table. For companies, though, that weaker pricing power in services and those rising input costs in goods, that means that the margin math is going to start to get a lot trickier for investors out there, eventually. For now, though, corporate income statements are taking it in stride, a relatively solid start to the reporting season for bank earnings for the second quarter, and decent guidance so far for the third. Executives, though, peppered with questions about the trade war impact. Internally, at the banks, not much impact at all, according to Citigroup. For consumer clients, Wells Fargo says just a touch of downward pressure on loan demand. And for corporate clients, JP Morgan saying executives, well, they're just finally accepting that they just have to get through this.
Right, and investors are looking forward to getting through this as well. And you can see that reflected in the price action of bank stocks. So the white line here is the KBW Bank Index, which includes Citi, JP Morgan, and Wells, along with 21 other lenders. And you can see how this group has outperformed the S&P 500 in blue, as well as the NASDAQ 100 in yellow over the past 12 months. But just since the low in April, and here we go, the KBW has returned almost 40% compared with the S&P 500's 26% return. Tailwinds for the banks include active trading desks, easing capital requirements, and an improvement in deal making and IPOs. Romaine?
All right, well, Wells Fargo did report this morning the share is sliding. This after a miss on net interest income for the most recent quarter and a lowering of its full year guidance for net interest income going forward. We should point out that the bank actually did pass a very interesting milestone, crossing that $1.95 trillion asset mark, as now that Federal Reserve cap after years has finally been lifted. Mike Santomassimo joins us right now, the Chief Financial Officer at Wells Fargo. And Mike, I do want to start off with the net interest income forecast. And what gave you a little bit of pause going forward with regards to that number?
Yeah, well, first, thanks for having me again. If you think a little bit more broadly, and then I'll come back to net interest income. What you saw in the quarter was just a continuation of the trends we've been seeing now for a number of quarters. Good performance across a lot of our businesses, good stable trends on some of the inputs that go into net interest income, like deposits. You're starting to see a little bit of loan growth, come through there. Great expense control, continue returning capital back to shareholders. So the story is still the same in terms of the trends that we've been seeing. So it's kind of good to see it play out again. For net interest income, again, what you're seeing there, the trends aren't changing that much. Really what we talked about on the call was, as we allocate more balance sheet to our markets businesses, some of that is a drag in NII and get paid in fees or non-interest income. And that's what you're seeing come through. So we brought our guidance down just a little bit on net interest income, but it's largely offset in fees as we are continuing to see more activity with clients across businesses like commodities and some of our rates businesses.
With regards to the progress on the market side of the business, that fee business, is there a sense of a balance that you're looking for between the contribution you want out of that relative to the rest of the bank?
Well, I think it's one of the businesses that we've talked about now for a number of years, that's been very constrained by the asset cap that we had in place up until just very recently. And so there's a lot of demand from clients to kind of grow with them across a bunch of different asset classes. And so I would expect that business to get bigger, but I'd also expect the other businesses to get bigger as we grow as well. And so I think when you look across the 5 key businesses that we have across the company, whether it's wealth management, commercial bank, corporate investment bank, and the consumer businesses, there's opportunity for all of them to grow. I think you may see a little bit of that growth come first in some of the markets businesses, because that's where you see that pent up demand. But I do think all of them will grow as over a long period of time.
I just want to get some more from you on that asset cap being lifted now. You now have a clean slate on regulatory matters and plenty of capital to increase dividends and buy back shares, both of which you have announced. So just take a step back for a moment here, Mike, and share with us how significant a moment this is for you and the team. How relieved are you, for instance, that this asset cap has been lifted?
Yeah, look, it is a big moment for the company, kind of a pivotal time for the company. This has been something that's been worked on for years and years now across many thousands of people across the company, and so we are very thankful for all the consistent effort that people put in over the years. And now it gives us the ability to grow, and we've got to do that in a controlled way. We still have to, we're still going to continue to embed the risk and control frameworks into the kind of the DNA of the company. We do have a little bit more left to do to kind of close out the consent order completely, but we have an opportunity to grow, and I think that's like the exciting part. And when you look across each of the businesses I just mentioned, we're very optimistic about sort of the opportunity that's there across every one of them. Because part of what we've been doing over the last 4 or 5 years while we've invested in the risk and control work is to invest in those businesses. We simplified the place, we focused on the core businesses, and then we've been just systematically adding people, improving technology, and adding the capabilities we need to grow. So we look forward to that.
So now, one area, Mike, that you've identified that you'll be growing in is credit cards. So I'm curious on what the thinking is on launching a premium credit card targeting high-income customers with elaborate reward offerings. We know that Chase has the Sapphire Reserve, there's the Amex Platinum, there's the Capital One Venture X. What's the thought process there?
Well, I think our plan in the credit card business started back at the end of 2019. We're a new team, and since then we've got a brand new set of products that are growing. We've been investing in the technology. We likely have a couple more products coming out over the next couple of years. And I think what we want to be able to do is compete across the full spectrum of products that are in the card business, not just on one side of the spectrum. And so I think you'll see us continue to invest in the product set to make sure that we can compete across all of the full spectrum there. And I think we'll see what the product looks like and when it comes out over time, but we'll do more in servicing that higher end consumer over time.
With regard to the idea of the health of the consumer, Mike, I mean, you talked about this on the conference call. You and Sharf talked about this on the conference call. The idea that you had seen some softness with regards to loan demand. The idea that consumers are pushing back, maybe just a little bit from the table. And I am curious as to what degree of severity you think that trend might end up, how that trend might end up being playing out.
Well, look, I think consumers and commercial customers, are largely in really good shape, right? I think we're seeing lower, lending demand come through in some of the portfolios, but that's because people are paying down their credit cards at a higher rate than they have historically. There's still a lot of excess liquidity across many of the customers. If they have investments, those are doing quite well, overall on average, as you look at what's happening in the market. And so the credit trends are actually really, really good. And so what you see at times, though, is people can be a little prudent in their spending or in sort of investments commercial customers are making. But when you look at the spend data, it's still growing year over year. And that's consistent, and I heard you talk before I came on about different categories of spend, maybe up or down, or CPI in different categories may be up or down, but really that spend is just moving around to different categories, whether it's services, products, goods, depending on sort of the month or the week. But just about every week, spending is still up year on year, both on a credit card and debit cards. And so it's actually performing pretty well, and it's a good sign of sort of the shape that both customers, consumer customers and commercial customers are in. And so it sets up the rest of the year to be pretty good from a credit perspective, because a lot of the delinquency trends that we're seeing are better than what we would have modeled, and so those will play out into lower charge-offs over time as well.
All right, Mike, got to leave it there. Always appreciate you taking time. We'll let you get back to it. Mike Santomassimo, the CFO over at Wells Fargo. When we come back here on The Close, a big program ahead, a conversation with the co-founder of 1789 Capital, Omeed Malik, and partner Donald Trump Jr. That's coming up in just a bit. This is The Close on Bloomberg.
JP Morgan, Citigroup, and Wells Fargo kicking off the earnings season for the big banks, and it was a solid showing despite lingering concerns on tariffs. All this makes for a decent setup into Morgan Stanley, Goldman Sachs, and Bank of America's reports tomorrow. Joining us now with more, Erika Najarian, Managing Director and Equity Research Analyst covering large cap banks and consumer finance at UBS. So the volatility that we saw in April really boosted activity and led to some big revenue for trading desks across these big banks. We'll see the more of the same for Goldman and Morgan Stanley?
Yeah, absolutely. And I think also what we're discerning from the quarter's results is after the dearth of activity in April in investment banking, you really saw a big pickup in the month of June. So not only did trading outperform, but you also saw a nice outperformance in investment banking and commercial loan growth. So actually the setup is good for Goldman Morgan and also potentially Bank of America. Although what the market is clearly saying is they're a little bit nervous about whether or not Bank of America's results will look more like Wells or look more like JP's.
Yeah, and I guess that raises a question of how conservative were these banks in the first quarter in projecting their full year outlook?
I think they were pretty conservative on the investment banking side. I think Wells, I know you had Mike Santomassimo on earlier. I think with Wells, in terms of lowering their net interest income guide, it really has to do with the mix of what's contributing. Wells Fargo is an evolving company. It's no longer just an oversized regional bank. And so there's more trading contribution to their net interest income, which comes at a lower margin. But I think for the most part, the banks were, very cautious in terms of what they were seeing from activity levels in capital markets to loan growth and putting in more rate cuts into their forecast. And so that's why I think you saw the upgrade from JP Morgan in net interest income as they took rate cuts out of the curve and activity levels, still remain strong, even in the consumer and in card.
I am curious, as sort of we start to see a little bit more expansion in card, at least at some of the banks, and of course there was the news today by Citigroup of this sort of ultra premium card, presumably to compete with the Centurion over at Amex and the Chase Sapphire. Is the net interest income proposition on that higher end card actually better than what it is for the middle market?
Look, it's that's a tough one to extrapolate, but let me try. So the ultra premium client tends not to revolve, right? They spend a ton, but they tend to pay it down. And so why these, companies love these customers is not because they contribute so much to net interest income and carry balances, but because their credit is so good and they spend a ton, so they make a lot of, discount revenue or interchange revenue as they continue to spend. So I think that's what it is. On the middle market side, that tends to be very contributory or contributive to net interest income. And I think you're starting to see a pickup there. Once the regional banks start reporting sort of in the middle of the week, we'll start really seeing if the regulatory trends in terms of the uptick are coming through in earnings for the second quarter.
Well, with regards to the regulatory trends, the broader regulatory trends in the financial sector, and I guess maybe deregulatory might be a better phrase, there has been a lot of optimism with regards to what that means for a deal activity. So for those banks that are a little bit more reliant on that, is that something that they can actually count on? Because when you listen to what you heard the JP Morgan CFO say, as well as the CFO on Wells Fargo, and I know they still have a long way to go with regards to their IB business, but the idea here is that that may not necessarily accelerate as fast as some investors have priced in.
So, Romaine, what's been surprising to the upside from this administration is how quickly regulatory reform, or to your point, deregulatory reform is unfolding. And I'm much closer to what's happening with the banks as opposed to other sectors that would affect M&A. But if the banking sector is any indication, regulatory reform is coming at a much faster speed than it did during Trump 1.0. And so not only are you seeing more balance sheet available for clients from the banks themselves, but you're potentially seeing sort of less barriers for approvals in terms of mergers, and that's positive, in two ways. Not only are you unlocking capital from the banks themselves, but their clients are also able to get the deals approved, and that's positive for advisory activity. You saw the pickup in June, and I suspect that everybody is going to be rather cautiously optimistic about what that means for the rest of the year.
All right, good stuff. Erika Najarian, Managing Director and Equity Research Analyst covering large cap banks and consumer finance at UBS. Thank you. All right, we mentioned this earlier, but a procedural vote on key crypto regulation failing in the House of Representatives, putting pressure on shares of Circle and Coinbase, as well as Bitcoin overall. Let's bring in stacy-marie Ishmael. She is executive editor here at Bloomberg News covering crypto. Stacy-Marie, tell us a little bit more about this measure, because there are three pieces of legislation here, right?
Yeah, this was one of the things, and you can tell from the market reaction that people didn't think there would be any problems with. The way to understand it is, the Republicans just had to agree to make a vote to then vote on the other actual big pieces of legislation, and they did not. The House voted against having consideration of these other industry bills go forward. That spooked a lot of people, and we're now starting to figure out what are the actual objections to having that go forward. Marjorie Taylor Greene posted on X that she wanted the ability to make amendments to the Stablecoin Act that's making its way through the House. Other folks haven't commented so far. I think the main takeaway for the market is this is not the end, right? They can vote again, and so everybody involved is trying to whip up enough votes on this procedural bit of business to be able to move forward with the rest.
Is there a sense, though, that there is enough bipartisan support? I mean, prior to today, whatever procedural issues, this is kind of normal for Congress, and they'll extract whatever pork they want out of it. But at the end of the day, was there enough support heading in to this vote?
Certainly for the bill related to stablecoins, that has tremendous bipartisan support, and enough that you have major industry leaders. You have Jane Fraser of Citi saying today that Citi is considering looking into how a stablecoin could make sense for them, right? So you don't get Wall Street executives out here commenting on these kinds of things if they didn't think that this type of legislation was going to go through. Yeah, and the fact you even have the head of Citigroup even talking about it says a lot about how far we've come. Stacy-Marie Ishmael, who leads our crypto coverage here, an executive editor for Bloomberg Editorial, as we keep an eye on the crypto market and we keep an eye on the broader market as well. The S&P right now trying to struggle to get back into the green. You take a look at the 30-year Treasury yield, and of course, a lot of this being whipped around by the earnings that we got this morning, as well as that CPI data. Joining us right now is Mike Contopoulos, Chief Market Strategist over at Richard Bernstein Advisors, Deputy CIO, I should say, Richard Bernstein Advisors. Great to see you, Mike. Let's start off first with this CPI report and whether it changes any sort of calculus as to what the Fed may do next, and more importantly, how the market will react to it.
No, I don't think it changes anything that the Fed's going to do. I think the bar was incredibly high for them to have to cut in July, and I don't think we cleared that bar. So I would expect no cuts in July. In fact, the market's even pricing less of a chance of a cut in September, now slightly below 50% last I checked. So I don't think it's really changed a whole lot, certainly not from our view. The fact of the matter is durable goods are still seeing some inflationary impulse, and I think that's likely to continue as you get later into the year.
Do you get bored when people ask you these questions? But this has been the parlor game in all seriousness for quite some time, and a market that's still camped out at a record high. This doesn't seem to have been fazed too much by the either lack of support from the Fed about whatever cracks you might be seeing on tariffs and the economy, and of course corporate earnings, which I know the bar is low, but so far, it looks like most of these companies are going to come in ahead of that.
Well, so I think what gets boring is discussion of the narrative rather than the hard facts. And the hard facts are you're seeing margin compression, you have really hard comps versus last year in terms of earnings. You've got an incredibly rich market and a ton of tail risks out there that really no one's paying attention to. And I think from our perspective, at some point, fundamentals need to start winning out over narratives. And the question is just, what's the catalyst for that, and when do we see it? Is it companies actually reporting and missing? Is it, inflation coming out hotter than expected? Is it some sort of other event that no one can really anticipate? We'll see.
You point out that there's scarcity to certainty at the moment. So where does that leave investors in terms of where they want to position themselves?
So I think it depends on which asset class we're talking about. In terms of equities, there's obviously certainty in high quality companies that have a history of increasing dividends over a period of time. So we really like high quality dividend payers. The traditional defensive, staples, healthcare utilities, clearly have a quality factor to them. The areas to avoid, we think, are deep cyclicals and very cyclical areas of the market. And one particular area that is a cyclical that's also very, very rich, we don't love, which is tech, comm services, and discretionary, or the tech complex, as I'll call it, as well as EM. So we think you avoid emerging markets, you avoid deep cyclicals and other types of cyclical companies, and you move more towards your traditional quality and defensive plays. On the fixed income side, it's agency mortgage-backed securities. In my view, they by far the best option for certainty and quality certainly relative to corporate credit.
In international markets, you say you can find quality in Europe, Japan, and the UK. I want to talk about what's going on in Japan's bond market, because there's a bit of a rout right now, and the 10-year yield on the JGB is at the high since 2008. Is this bond vigilantes at work?
Yeah, I think it largely is. I mean, we're pretty much neutral, Japan, so the real quality factor that we're talking about is mostly related to UK and Europe. Not that we hate Japan, but it's just not the area where we're really overweight at the moment. But yeah, I think it's the bond vigilantes at work. You're seeing signs of inflation. Monetary policy is not necessarily supportive to the rate environment as well in Japan. And you're really starting to see a breakout into a new regime. And during breakouts, new regimes, you tend to get a lot of volatility. And I think that's what we're seeing in Japan.
On that front, though, there's been a lot of discussion about the recent gains in the dollar after, of course, what has been a phenomenal drop to start the year. Are you of the mindset that we maybe did see the bottom in the dollar sell-off?
Not necessarily, Romain. I mean, if you look at the last 15 years or so, the dollar's just back to where its range, and it still has the potential to fall further, I think. But I'll tell you, in all my years in Wall Street, which is approaching now over 25 years, I've seen the best FX strategists and managers get it wrong more than 50% of the time. Yeah. So I don't try to predict FX to a large degree. But I think if you look at the trend, I think that over the next 1, 3, 5, 7 years, I think you can make a case that the dollar could weaken further even.
As we get deeper into this earnings season and we get the big tech companies and more of the consumer-facing companies, do you have some confidence here that even if the companies do suggest that there is an impact from relative various policies out of Washington, that still will not have a material impact either on margins or bottom line EPS?
Yeah, we do. Yeah. We think that the impact not only from tariffs, but even before tariffs, we were forecasting a peak in the earnings cycle this year. So one way or another, earnings growth was peaking. Part of that, remember, anytime you talk about growth, you have a base effect. And base effects were pretty strong. You've had a positive earnings cycle now going on 9 quarters, which is quite a long positive earnings cycle. And as you look back relative to history, the comps start to get quite hard regardless of tariffs. Now if there are tariffs and the impact that can have on margin compression as well as top line growth, and I think it's a very, very high hurdle to continue to improve earnings growth from here.
All right, Mike, always appreciate you coming in. Mike Contopoulos there, Deputy CIO, I got it right this time, Mike, over at Richard Bernstein Advisors. As we continue to count you down to the close, we keep an eye on the broad markets. A mixed day with the S&P in the red slightly, the NASDAQ's in the green slightly on the day. But when we come back, we're going to talk about investing across the board, in the public and in the private space, and maybe sometimes with a political bent. Donald Trump Jr. and Omeed Malik, partners in 1789 Capital, are going to be joining us in just a bit to discuss their investment strategy and their outlook on markets, crypto, and so much more. This is The Close on Bloomberg. Welcome back to The Close, and welcome to a special conversation with the principals of 1789 Capital. the politically connected venture firm with a focus on companies that are carving out space in a parallel economy that caters directly to conservative values. Its more notable investments include XAI, prescription drug provider BlinkRx, and defense tech companies Anduril and Firehawk. Omeed Malik co-founded the firm in 2023, and Donald Trump Jr. joined as a partner last year. They both join me now along with Bloomberg surveillance co-anchor Anne-Marie Horder here in Studio 2 in New York.
Thank you so much, Romaine. Yeah. And thank you, gentlemen, for joining us here in New York at Bloomberg TV. Tomorrow morning, you're going to be downtown at the NYSE, 9:30, ringing the opening bell. Omeed, I just learned it's your 4th time doing so. Right. This SPAC is for an online gun retailer, GrabAGun, but there's been a tremendous amount of demand for this. What do you think is driving that?
Well, I think it's an extension of our thesis that Don and I started, 5 years ago? Yeah. Which was using various mechanisms in finance to try to push back against overreach we saw in the private sector, mostly at the behest of ESG and DEI mandates. What's happened is, through those mandates, private companies that control a lot of the economy have starved certain industries of financing. You guys obviously know that that's happened in fossil fuels with some of the mandates we've seen with public companies, but it has also negatively impacted guns and ammunition. So we used a SPAC to take a company called GrabAGun public, in furtherance of the Second Amendment, and the people have overwhelmingly supported it. This is now, having just closed a few minutes ago, one of the most successful SPAC transactions in history. We received 0 redemptions from trust, meaning the company will receive from our team tomorrow, when we ring the bell, over 170 million in proceeds.
Wow, when this was first introduced, I read it was actually only just at 100 million. Obviously, this is politically controversial. You're talking about an online gun company being really direct access to the consumer. Are there safety concerns in this, Don?
No, I mean, that's the big misnomer. They say you're not getting a gun to your doorstep. You're still going through federal firearms license dealers, but we're also...
To go physically pick it up.
To go physically pick it up. That's where you run your background checks again, and they like to pretend there's not such a thing, but it actually is very real and it's very regulated. But this is the way that regular people are buying. Throughout the crime of the last few years that you've seen, women are now entering the gun market. The experience of going to your local gun shop, it may be fine for me. When I walk in, it's, hey, Don, how's it going? If you're a first-time gun buyer, if you're a female, if you're someone that's young, that's an uncomfortable experience in many cases. So GrabAGun allows you to do that the way you'd buy everything else, like you would on Amazon if you're buying home decor or other goods. And so we're bringing the experience that they're shopping with everything else to the regular consumer, and it's been incredible. And so it's a company with real revenue. They're doing $100 million a year, real profit, and, you know, pretty kind of cool to take a gun company public on the New York Stock Exchange. That's not something that I imagine many people would have envisioned a while ago, but there has been that big pushback from a big portion of the country that says we weren't able to do these things. We were debanked, we were de-insured, we were de-everythinged for so long. So our whole thesis was to give a big portion of the country what they've been looking for and to free up and really democratize the capital markets.
And you've given them a slice of that. Of course, there's still going to be a lot of big institutions that will say, okay, we don't want to actually invest in a gun company of any form. And I know that the whole thesis behind 1789 and some of the other projects you two have been working on is designed to sort of provide an avenue for those areas outside of just firearms. What else are you looking at, Don?
Well, we've obviously mentioned some of the companies that were invested in, again, a contrarian approach, but something that, again, a vast majority of the country, or at least a solid portion of the country, really wants to engage in. We took another company public 2 years ago called Public Square, again, an online retailer for people to buy American-made goods and to support the countries that they love. That's sort of morphed also into now a payments processor, since so many of the transactions that you saw for, you know, conservative or right-leaning type of goods were basically debanked. I've had businesses that I've started actually get debanked by getting a letter, hey, by the way, there's no more money in your bank account. We have a cashier's check in the mail. We just don't want to do business with you. Not because we were doing anything else, but because we didn't go with the mandates of whatever it was of politically correct policy at the time. And so many Americans felt left by the wayside that we said, hey, this is a pretty solid market. If we can cater to half the country, that whether it directly or they just know it's a potential, we're going to be left by the wayside. That's a solid business to be in.
Another company in the industry that kind of falls into that category is what we were seeing with Polymarket and some of these, prediction market firms. And of course, they just won a reprieve today, a couple of investigations that have now formally been dropped. You're an investor in that. Obviously, you have a connection to the Trump administration. I am curious as to whether you think we're going to see more progress in the prediction space, not only with Polymarket, but with Kalshi and some of these other things, to operate more freely in the way that those founders have articulated.
So yeah, let me answer that in kind of a way to also summarize our overall investment thesis. So he talked a lot about the response companies, this parallel economy. That's what we've been using our SPACs for. 1789's mandate is even broader than that. It will include some of that. We have, for example, invested in Substack, which is a free speech platform, protecting the First Amendment. But we also go into several other areas. One is areas that are going to enhance the security and prosperity of the United States. So think defense tech or the reindustrialization of the United States. The third is the area that we talked a little bit about, areas that have been underserved, fossil fuels, guns, that we see an arbitrage opportunity in. And then finally, where you're starting to pick up on with Polymarket, areas where I think the government or certain incumbents have failed miserably. That's the reason we got into BlinkRx, which reduces drug prices. It's an area of the market where the government has failed to reduce pricing, and we find this is a disruptor. SpaceX falls into that category as well. NASA failed, and SpaceX took the mandate. Polymarket falls into that, in that people lost faith with pollsters. They were constantly just paid off and hired mercenaries. And what Polymarket has shown is that you can basically take the markets to try to predict what the truth is. And because people are going to put their money behind what they really think, it's the same thing you see with using markets in finance in order to predict things. You can do that now with polling around politics and other issues as well. So the last thing I'd say about Polymarket is it also announced that from Founders Fund, they're going to have over $1 billion valuation, which we like because that marks up our investment 3 times.
Well, they've been accurate. They've been right. Okay, I've been in politics, at least the game peripherally now, for a decade. And how many times? I mean, we saw it the week before the election. Kamala Harris is going to win Iowa. It's like that. I don't know, man. I was in Iowa a couple days ago. I don't think that's going to actually happen. They were able to get that. So they saw the way these markets and some of these traditional sort of political institutions have been able to be weaponized for the benefit of the establishment. And they've gone against it. They've proven to be right, and that's a solid investment.
Well, on that point, Don, and we certainly saw that in the presidential election. We also saw that at the local level here in New York with the kind of the surprise victory of Zohran Mamdani in the mayoral primary. And I know there are a lot of folks, particularly in finance and real estate, who are wringing their hands over the prospect of Mayor Mamdani. But I am curious as to what you think of not so much him, but about the sort of a groundswell of support that he got, particularly from a lot of young people in this city, and what they're asking for out of their mayor or potential mayor.
Listen, I think it's going to create a serious problem for New York. I don't remember what the exact stats are today, but I remember 8 years ago when I was getting ready to leave New York myself as a political refugee to the free state of Florida from the People's Republic here in New York City.
It's not that bad.
It is if you're me. It is if you're me. And you're dragged in front of every court and you're sued for all these. I'm the first person in the history of the world to get sued for paying back a loan on time with interest, just so we're clear. I get it, it's a little bit different, but I think at the time it was something like 18,000 people in New York City paid 84% of the tax. Those people are mobile. They can move wherever they want. So as a real estate holder in New York, I guess it sucks for me. As a real estate holder in Palm Beach, it's going to be incredible because those people are going to move. They're very mobile. They've had enough. They understand what's going on. And they're not going to continue to subsidize the nonsense that hasn't changed anything. We've seen these promises before. It hasn't worked. It didn't work when they promised communism in Europe. It didn't work in the Soviet Union. Certainly hasn't worked anywhere else that it's been tried in the world. It's created more poverty than any institution imaginable. And it's sad to see literally the home of the free market, the home of capitalism, New York City, take this sharp turn to the left. And I don't think it's going to work out well. And I think people understand that. It's a little troubling watching Andrew Cuomo now try to come in as this sort of third-party candidate. And just so we're clear, we probably didn't get along that well for the last decade, but my first political fundraiser in history was for Andrew Cuomo because I was a real estate guy in this city. And he was the attorney general, so he signs off on your offering plan. So Don, I know him well, but this is going to split a vote.
At the New York Stock Exchange, why didn't you guys wait to maybe go to the new Texas exchange, if that's how you feel about New York?
Well, because we're here now. I think that'll be a place that will take companies public in the future, but we're here now. And I think for us and for our thesis to be able to ring the bell of the New York Stock Exchange taking a gun company public is sort of an ultimate vindication in what we've been talking about all along. I mean, again, there's not a time in modern history where you think that's going to actually happen. So, this is our thesis really, manifesting itself. Like, we're back, we're going to do these things, and we're going to fight for the freedoms that Americans love and deserve.
But politics is on a 4-year cycle. How do you do that when you look at 2028? You're investing where you say conservative values, anti-ESG, you call it MAGA, Make America Grow Again. What do you think about, say, there's a changing of the guard in Washington in 4 years?
When did Fox News do the best?
I'm guessing
during Obama's 2 years, 2 terms. So we have an all-weather strategy. Either we're the loyal opposition, or like we are now, we've been vindicated culturally and politically with what we've been saying. Ultimately, I don't think this is partisan. I believe we represent the majority of the country, actually. And I think there was a period of time where it lost its way. And we were doing something that I think is actually totally capitalistic. We're simply providing people with choice. ESG's been around in earnest since 2010 and became a multi-trillion-dollar asset class. And at the same time, when you map out their returns, they fail to deliver, and that's just the facts. Why isn't there a fund out there like ours who's providing an alternative for people to invest in?
Fair point, but do you worry at all that your strategy, EIG or whatever you're calling it, ends up being the next ESG, where it's basically just sort of a niche instrument for a niche group of people and maybe it doesn't deliver?
I don't, because if you look at the principles of what that acronym stands for, entrepreneurship, innovation, and growth, it's everything Don was just lamenting about New York City, which is to say that this was the place that capitalism are supposed to be universal values. It's one of the things, if you have a country like America, is supposed to be our unifying ideology, is capitalism. And it does give me hope that tomorrow the New York Stock Exchange, which has been great, by the way, as a partner, is welcoming us to basically do a ticker under the letters PEW, Pew, tomorrow.
A little takeoff on pew pew, like shooting a gun, but it's also important. I think the last 4 years taught Americans a lot of things, right? They became unafraid to speak up about things that were obviously insane, things that went too far. You see that manifesting itself right now, in so many cultural issues. The trans women in ladies' sports, men playing in women's sports, people who were afraid to voice those opinions about how asinine a concept like that was just a few years ago are now, these are 90-10 issues. We're taking the 90. So we're okay with that competition if it just means that everyone's actually thinking rationally. We're fine with that. If we're the catalyst for that change, we're good with that, because that's what's good for the country and that's what's good for America.
Speaking of voicing of opinion, you have a big stake in XAI. Obviously, there's been some tension with the former First Buddy. Has that changed how you view that company, and even maybe more so in the financials? We've reported that they are burning through a tremendous amount of capital every single month. You still want to maintain that investment?
By the way, actually, yes. One of the worst publicly traded companies of all time was Twitter before Elon Musk took it over and made it profitable. So I'm long on Elon. Our fund is. We're invested in every one of his companies. We're invested in X, which was Twitter, XAI separately. Now they've merged, which is also a brilliant play, because the feedstock that these AI companies he now has in-house with a platform that has over 600 million users. It's genius. The competitors don't have that. We're also invested in Neuralink as well. So we think the Elon index, if you will, is something that's here to stay, and the companies are demonstrating their success independent of whatever personal issue may happen, which obviously he and I want to get resolved and move on in a positive fashion.
Do you have a personal relationship with Elon?
Of course.
Yeah, we do.
It's still healthy despite...
the reality is, hey, there's going to be political differences. The political world is different than the world in which you often function with. That creates a lot of other tensions. I mean, I love Elon as an innovator. I mean, he's got, without question, one of the top innovators of this century, perhaps ever. And so, him focusing on those things, I think, is very positive. So we've always been able to maintain that relationship. I think that comes back. Again, politics is a very different game. I learned that one the hard way 8 years ago. People create obstacles. They create headaches that aren't real. They aren't.
You are making it, because look, just a few months ago in February, SpaceX was valued at $350 billion. They just did an oversubscribed round for $400 billion a few months later. This is constantly happening in every single one of his portfolios. There's reports out there that XAI, which was at 50 or 60 billion less than a year ago, is going to be at 200 billion. So the private markets and markets generally are speaking, and they still love the portfolio.
When it comes to politics, though, it is in our financial markets now. Policy in Washington constantly drives what's going on. People are glued to Truth Social to understand what potential the next tariff rate is. Don, I want to get your sense, given the fact that you are the president's son. I asked your dad once about the Trump put, if it exists in the market. Is there a threshold he's unwilling to maintain when it comes to either whether it's tariff policy or something else because of what is going on in the financial markets? And he once talked about the bond market getting yippy. Do you think a Trump put exists?
I don't think so. I think the reality is he's one of the few people in politics who's willing to play the long game. We don't do that, right? We have very short-term cycles. People make bad decisions today to get a quick result tomorrow that is, disastrous for us in 50 years down the line. He's the guy that's willing to say the things that need to be said today, who's willing to take some of that heat now to be able to have the end result that's beneficial for the country in the future. That's what he's done very consistently. You saw that even a couple of weeks ago. S&P's down 5. Oh my God, it's the Trump crash. Well, what happened when it hit all-time highs? What, last Thursday? What happens when it recovered 10 days later after that? He gets credit for the negative, but he doesn't get credit for the positive. The reality is these things manifest themselves over time. We've become an instant gratification society. He's one of the few people that's actually a decision maker that is playing the long game and doing so for the benefit of the country.
You nod your head there. I want to give you the last word, but I also just wanted you to just at least touch on some of the other two big political issues going on right now, the legislation on crypto and the potential freeing of Fannie and Freddie. Where does that stand?
Well, yeah, I'm on the board of Fannie Mae, and that was something that I wanted to be able to serve the country. I'm excited about making sure that those institutions stay in a great spot, and see how I can work with Commissioner Pulte, Secretary Besson, and Secretary Lutnick to improve upon them. And that's what my role is, given my experience as an attorney and capital markets professional and investor. That's why I did that. As far as crypto legislation, next week, we're excited about that. That's going to be another signature piece of legislation the president's going to pass right after the big, beautiful bill. And I think that's going to be something we needed and brings crypto out of the shadows as it was in the previous administration. And it's something, or another reason why the president had that industry support.
Crypto is going to be the future of finance.
Yeah.
Okay. We were doing everything imaginable in the prior administration to send that to other places. People want to be in America. They want to invest in America. They want that stability. What they needed is some guide rails. They needed a framework in which they could work, even for us in the crypto platforms that we were developing, whether it was American Bitcoin, whether it's World Liberty Financial. We didn't get into that because we knew all that much about crypto. We got into it out of necessity because we were getting debanked. There wasn't a person in this city that I couldn't call and get a loan for a real estate project a few short years ago. Then we became Politica, and all of a sudden you're persona non grata. So crypto's the future. To be able to have the legislation to create those guardrails, to be able to keep that industry, this is going to be a multi-trillion-dollar industry, and it should be based here in America. America should get the tax benefits of all of that. They should have the innovation, the growth. That's strategic thinking, and so I'm super excited about that bill because I think it's going to really make sure that America is the home of crypto and blockchain technology for the future.
All right, I think that's a great place to end it. Really appreciate both of you taking time for us. Donald Trump Jr. and Omeed Malik over at 1789 Capital. Back to you, Scarlett.
All right, good stuff. Fantastic conversation. And by the way, we need to go now to the president, who is speaking at the Carnegie Mellon for Energy and Innovation event in Pennsylvania. Let's take a listen.
Bombs and planes and from, frankly, storms. You see what happened, that horrible situation in Texas. And you'd be subject to that. And it's fragile, but it is old, and it can't have the capacity unless you totally rebuild it. That would take decades. And I said, well, why don't we do this? Why don't we, when you build your plant, wherever you may build it, you build your own electric plant? And nobody took it seriously. They sort of looked like, I can't really take that seriously, because they didn't believe it was happening. So the smartest people, some of them on stage right now, were saying, huh. And then they'd say, well, how do we hook up to the grid? We want to hook up to... They didn't believe what I was saying. And I said, no, I'm really serious. I'm going to let you build, right, Lee? I'm going to let you build with your plant. You're going to build, we'll make you like a public utility. You're going to build your own Con Edison in New York. You're going to build your own electric factory, and you're going to make your own electricity. So this way you can have a great plant. And what you'll do is if you have excess, you can sell it back into the grid. You'll even make money from the electric business, because these guys do know how to make money. They'll end up doing things that will be shocking. And you're going to make your own plant. So when I looked at the numbers before, I saw a board outside, and it showed how much electricity China's making. Well, we just started, but we're going to actually end up doing more than them, and it's going to be done privately, and you're going to own your own electric plants, and they'll be powered by maybe nuclear, maybe gas, maybe coal. You know, we brought coal back in. They won't be powered by wind because it doesn't work. I hate to say it just doesn't work. It's rather intermittent. You don't want it. It causes a lot of problems. But we have every form of fuel that you want to use for your plant. And you'll build a plant, you'll build your electric, and this way you have no excuses, because I didn't want to be the one that said, listen, we're trying to build that grid in 10 years from now, and you wouldn't be able to open. You're going to build it with your own plants. And so people heard that. They couldn't believe it, and finally now they believe it, because we have a couple that are already started, and they're building their electric plants along with their separate plant. And in fact, some of them are building the electric plant inside of their main building. So it's really exciting to see. But I was very proud of that, actually. White House AI czar David Sachs. David, thank you very much. Great job. David interviewed me on his podcast about, what's that now, 2 years ago or something in San Francisco, and I said, this guy's very smart. If I pull this sucker off, I'm going to probably hire him in some form. I got to get him in. But you've been doing great. Thank you, David, very much. Director of the Office of Science and Technology Policy, Michael Kratsios. Michael, thank you. Thank you, Michael. Thank you, Michael. Good job. They tell me you're doing great. Thank you very much. As well as State Senate President Pro Tem Kim Ward. Kim, thank you. Kim, good job. Kim's very happy right now. State Senate Majority Leader Joe Pittman. Joe, thank you. And State Senator Greg Rothman. Thank you very much, Greg. Thank you. I also want to recognize your great congressmen. These are friends. These are warriors. They just passed the great, big, beautiful. See, I add the word great. I like to say because the really was really supposed to be great, big, beautiful. They call it the big, beautiful. But I had great. They took the word great out. I was on a show called Deface the Nation or something like that. Ladies and gentlemen, Deface the Nation. And I said, I want a great, big, beautiful bill. And they named it that. And it really is. It was supposed to be 7 bills. Could have been 2 or 3, but it was supposed to be originally 7. I said, let's put them all together. And if you put them all together, there's going to be something for everybody. And that's what happened. And we got it passed. And Republicans did it. We didn't get one Democrat vote. Think of it. The biggest tax cut in history, and we didn't get a Democrat vote. And so many other things. No tax on tips. No tax on Social Security. No tax on overtime. But the biggest tax cut in the history of our country, you got that. Also, the biggest deduction, you know, you have a 10-year period. Last time we had a 1-year period. Now you have a 10-year period. And that's what made the first one. We had the most successful economy in the history of our country during my first term. And we passed a bill. But that bill, honestly, as good as it was nothing compared to this one. And the biggest thing...
And you were listening to the president speaking at the Carnegie Mellon for Energy and Innovation event, talking a bit about the legislation that was passed, the One Big Beautiful Bill. If you want to continue listening to that, you can go to the Bloomberg terminal and type Live Go. In the meantime, we are keeping you on top of what's happening in the markets right now. And the S&P 500 has extended its losses. It's now down 0.25%. But really what you're seeing here, Romaine, is a divergence, right? Because you've got the semiconductor stocks, namely NVIDIA and AMD, doing quite well, and that's lifting the Philadelphia Semiconductor Index up 1.5%.
Yeah, absolutely. And you're actually seeing a lot more activity right now in some of the mid-cap space, despite the fact that you're seeing right across the screen in some of those indexes like the Russell 2000 small caps. But the idea that within that, you are seeing a lot of the materials companies, you are seeing a lot of companies with outsized exposure, potentially positive outsized exposure to policies coming out of Washington, those stocks moving higher. So a bit of a rotation of cash, just not into anything meaningful enough to actually move the bar.
And that's a good point. Not into anything meaningful enough. Let's see how long this goes on for. Let's bring in now Mandy Xu. She is VP and Head of Derivatives Market Intelligence at CBOE Global Markets. Mandy, always a pleasure to see you.
Always good to be here.
Thanks for joining us. So talk a little bit about what's driving this market right now. I mean, we are at the start of earnings season, and obviously we're fixated on what the companies will actually say about what they see out there. But in the absence of, you know, a number of companies coming out to say that, it feels like we're kind of clutching at straws.
Yeah, well, I think we're waiting for earnings, and I think this earnings season will be important in that it will let investors kind of get a preview of kind of what's going on in terms of the economic impact of the tariffs. What is interesting in the derivatives market is that while index volatility, like the VIX, for example, has fallen, single stock volatility over the past few weeks has actually increased quite a bit as investors kind of position for this earnings and also position for what you guys mentioned, this rotation trade, right, between sectors, between factors. That is what we're seeing in the derivatives market.
Well, that's what I'm curious about, too. I mean, because there's been a lot of talk about the softness that we've seen as of late, despite the record highs. This has been a somewhat range-bound market. But the idea is that the money isn't necessarily coming out of the market. It is kind of staying there, just, like I said, rotating to other spots. And I am curious as to whether you see any risk in that. The idea that as that rotation, does this become kind of musical chairs? And then when we do get a shock of one degree or another, then everybody jumps out.
No, I think this rotation is healthy, and then this dispersion that we're seeing between sectors and between stocks, it tells you that we're in a more fundamentally driven market. It's not so much driven by headlines, and in fact, to me, what really stands out is just how much investors have kind of looked through all these tariff-related headlines. Right, last week we got a barrage of tariff threats and tariff headlines, and implied volatilities across asset classes not only did not go up, but they actually fell, which is a very stark contrast from what we saw in April. So I think this is kind of the volatility market is really telling you that investors are kind of tuning out, if you will, the tariff threat, whether that is right or wrong, we'll see, but they're really focusing on stock fundamentals, they're focusing on earnings, and that is really what's driving the market right now.
You mentioned how single stock volatility has increased as we head into earnings, and while we've seen the VIX overall not as volatile, that number has actually come down. We have a chart really highlighting that. What does that say about how cheap or expensive volatility is on individual stocks versus the S&P overall?
Yeah, so this tells you again, so individual stock volatility is expensive relative to index volatility. Again, not surprising given kind of where we are in the cycle, where we are in terms of earnings. I caution against looking at the VIX level itself and say, oh, volatility is cheap or rich based on the level, because what we really should be comparing it is kind of how the market actually been behaving. So one of the things that stands out to me is that VIX at 16, while low, it's actually not cheap because S&P realized volatility is even lower. It's in the single digits, it's near a one-year low. So, against a backdrop of the market really not moving much, it's just kind of this relentless slow grind higher, VIX at 16 is actually pricing quite a bit of volatility risk premium. Even though the level itself is quite low.
Once you get beyond just the equities in terms of what you're seeing in terms of derivatives, are you seeing a meaningful difference in sentiment, or at least how you're gauging sentiment based on the derivatives activity that we're seeing in other pockets, non-equity pockets of the market?
No, this decline in volatility has been broad, has been across asset classes. Now, obviously,
because I was looking at treasury volatility, which was like no volatility at all, which was surprising.
So we have, you can track VIX TLT, which is looking at treasury vol, VIX IG, which is looking at investment grade credit volatility. All the volatility indicators that we have fallen significantly. Now, compared to their own long-term history, I would say credit volatility screens as the cheapest cross-asset vol right now, and gold volatility screens as the richest on our metric, cross-asset volatility.
Oh yeah, given prices and given spreads, I guess that would make sense. Mandy, always smart, always great to have you. Mandy Xu, VP and Head of Derivatives and Market Intelligence at CBOE Global Markets, helping us count you down to the closing bells. And it's kind of interesting too, she was talking about how a lot of people are looking through the tariffs, but they're also looking through some of the good news. I mean, Trump had touted that Indonesia deal and all these planes that were going to be bought from Boeing. And you saw a huge spike in the shares. That's now back in the red for Boeing, basically sort of a kind of like an hour-long reaction to it, and then basically back to where it was.
Well, the momentum right now is certainly not to the upside. It's kind of just hovering and holding on to the gains that we have seen. The Russell 2000 now at session lows, lower by 1.9%.
And you take a look at the VIX here, a slight, I won't really call it elevation, just call it unchanged on the day, right around 17 there, though a meaningful move higher in the dollar on the day and a meaningful move lower in interest rates as we break down all of today's market action starting now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through to that closing bell with the global simulcast. It has started. Tim Stenovic is in the radio booth. Emily Grafeo by his side today. Carol Masser has the day off. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Tim Stenovic, a mixed day in markets, down on the S&P 500 and slightly higher, though, on the NASDAQ.
Yeah, I mean, slightly higher on the NASDAQ. And I guess, like, I kind of was expecting to maybe talk about bank earnings or maybe the CPI data. But I think what is bigger for the indexes is what we heard from NVIDIA and AMD earlier today. And the government officials telling NVIDIA that they're greenlighting export licenses for the H20. That has shares of chip companies higher.
Speaking of what's moving today, Bitcoin is down 3%. Now, of course, this was after it hit a record high of 120K yesterday, but it is interesting to see not as much movement in the indexes, but crypto is really on the move today.
Especially after that House procedural vote on the crypto measures failed. And I mean, I'm not going to say that stocks are necessarily falling, but they definitely have drifted to the downside.
We should talk about the idea here, too, that just how lopsided the trade is. I'm glad you brought up the chip stocks, because when you look at the NASDAQ 100 and the fact that it's in the green, basically that's all NVIDIA, as well as some of the other chip makers like AMD and Broadcom. Without them, we'd be deep in the red. And it's a similar story for the S&P 500, NVIDIA, Broadcom, Microsoft, basically the biggest contributors to the upside for the S&P, but that's not enough to overcome the downdraft, Tim, that you're getting from Meta, Tesla, and names like that.
All right, we'll see what happens tomorrow with Bank of America, Goldman Sachs, and Morgan Stanley, and a host of other companies that are set to report this week, Romain.
Absolutely. As we get the closing bells here in New York, I guess at some point we will actually see them here on this Tuesday afternoon. The Dow Jones Industrial Averages looks like it's going to close out the day lower by roughly about 1% on the day, down by more than 400 points, closing in right around that 44,000 level. The S&P down by about 25 points or 0.4%. The NASDAQ Composite higher just by about 0.2%. But the big laggards, of course, were in that more cyclical space. Dow Transports down 1.6%. S&P 400 mid-caps down 1.8%. And the Russell 2000, Tim, down an even 2% on the day.
Hey, you make a really good point, Romain, about the massive stocks that were lower in the S&P 500. Kind of shocking to see this. Only 47 stocks in the S&P actually moved higher today. We had a whopping 455 move lower. Kind of speaks to the fact that some of the big names did move higher and kind of makes it a little lopsided for the day.
All right, and you can certainly see how lopsided it is when you look at the sector performances. That big chunk there is information technology, the biggest sector in the S&P 500, up 1.3% because of gains in chip companies. Everything else is lower. In fact, you've got 6 sectors finishing down at least 1%. The worst performers are materials, losing more than 2%. Healthcare and financials also down at least 1.5%.
All right, well, let's take a look at some gainers. Actually kind of easy for me to find them because I did start with chip stocks. NVIDIA shares finishing the day higher by 4%. The company said it received assurances from the Trump administration that sales of its H20 AI chip to China would be approved. This is a dramatic reversal by the White House. This move coming late yesterday, crossing on NVIDIA's blog. Late yesterday, U.S. government officials told NVIDIA they would greenlight export licenses for that H20 AI accelerator. This, according to the company late yesterday. Shares moving higher by about 4% today. We also saw a move higher from AMD as well. Also, let's talk Citigroup. Look at this. Shares rising to the highest level, going all the way back to 2008. A 3.6% higher on the day, 3.7% higher on the day. The bank said it would ramp up stock buybacks following a strong result in regulatory stress tests. Citigroup's traders also rode the tariff-induced volatility in markets to their best second quarter in 5 years. Revenue buoyed by record trading volumes in the quarter. Once again, Citi shares higher by 3.7%. And MP Materials shares surged today. You guys might remember we had the company's CEO, Jim Litinsky, on our air just late last week. Shares surging today by close to 20%, the highest intraday level going back to April 5th. Apple committed $500 million to buying the company's American-made rare earth magnets in a multi-year deal. Apple and MP Materials will establish rare earth recycling line in Mountain Pass, California, and develop a novel magnet materials and processing technology to enhance magnet performers. Yeah. It's part of Apple's pledge to spend more than $500 billion in the U.S. over the next 4 years. Shares of MP Materials higher by 20% today.
All right, let's get to some of the decliners. Wells Fargo was among the worst performing S&P 500 companies today. Fell about 5% to finish the day after a miss on second quarter net interest income. It also lowered its full year guidance for NII after another quarter of tepid growth. So interesting here to see that divergence in the bank earnings right now.
All right, I just want to jump in because we did get earnings from Omnicom. It's not just the big banks that are reporting. This is the advertising agency. The company reporting second quarter revenue that met analyst estimates, $4.02 billion, just slightly above the consensus estimate of just under $4 billion. Second quarter adjusted EPS of $2.05. That does beat the consensus estimate of $1.98. The stock moving slightly higher in the after-hours trade by 2%.
All right, and back on those decliners, BlackRock, after hitting a record high here on Monday, is now down 5%. It closed the day down about 5%. And it was headed for its worst earnings day drop in more than a decade after revenue and performance fees missed estimates in the latest earnings report. BlackRock, of course, is the world's largest asset manager, and total assets actually did hit a record $12.5 trillion as the company continues to grow into private markets. It grows its ETF business, particularly that crypto ETF lineup, really powering some of BlackRock's growth here. And yet, yet. Traders just wasn't enough here to quell traders' concerns about that revenue miss of that stock falling. And then finally, Newmont dropping today following the resignation of the company's chief financial officer. This is one of the world's top gold producers, falling about 5.7% to finish the day. And they announced yesterday after the close, Carolyn Ovelman tendered her resignation last week, and the company didn't disclose a reason for that departure.
All right, let's take a quick look at yields. We did see a lot of activity there, a meaningful move higher, particularly on the longer end of the curve, something that's been playing out now for the last few weeks. Your 30-year yield now pinned at that 5% mark. And you're also seeing the 20-year yield also camped out there as well, further steepening along the curve with your 10-year yield, flirting with 4.5%, and your 2-year flirting with almost 4%. And of course, all of this tied, of course, to a repricing of expectations around the Fed after that big CPI report this morning that seemed to suggest, at least for right now, no rate cuts, at least not to the largest extent that was priced into this market, are coming. Meanwhile, we go back to earnings and take a look at J.B. Hunt, the trucking company, moving higher in the after-hours trade. After reporting second quarter EPS, they came in a penny higher than street estimates, $1.31 on the bottom line, $2.93 billion in revenue on the top line. That was also a slight beat in dedicated revenue, also coming in higher than expectations at $846, which was rounded up to $847 million. That intermodal revenue number, a key metric there, in line with estimates at about $1.44 billion.
Okay, a quick break from earnings to talk a little bit about deficits in Europe and some European countries. Have you guys ever wondered how much a holiday actually costs a country?
I do.
Okay, well, it's a good thing you wondered that because we've got some answers. France is actually considering axing 2 public holidays. They're trying to do this in an attempt to tackle the deficit. If you canceled 2 holidays, remember they have 11 public holidays a year, which about the same as federal. It's about the same as federal holidays in the U.S. in most years, compared with 8 days off in England and Wales. So, kind of equivalent to what we have here in the U.S.
Holidays are the actual number of days.
What do you? Sorry, say it again.
Because some of their holidays are like a week long.
No. This is just these are just 11 public holidays. But there are businesses are closed for a lot more than that.
Yeah.
If you've ever been there in August.
Yeah. Like, are they taking into account the 2-hour lunch break?
No.
The 8-week vacations that Romaine's referring to?
They're not taking that into account.
Disappear to.
Okay, if you canceled 2 days, according to the Prime Minister, you could give a boost of several billion euros to the country. So,
wow.
I don't know.
What is that in francs?
It doesn't matter anymore. It's on the euro now.
Oh.
Okay?
Oh, I forgot.
Well, speaking of euros,
Brexit.
Brexit.
It has a good ring to it, Romaine. You should try to make that stick.
Sure.
Did it work out well for the UK?
It did not work out well for a couple other folks.
Yeah. Most of the exits have not totally worked out. No. All right, let's talk a little bit about other companies affected by the tariffs. Kerrygold Butter says that it's planning to slow down its U.S. investment because it needs more clarity on Trump's trade settlement with the European Union. And of course, if you ever bake and you use Kerrygold Butter, I mean, that's kind of the only way to go.
Hold on.
What?
Wait, you bake with this stuff?
Yes.
Oh, I just eat it straight out of the dish.
No, it's amazing when you bake with it. You kind of have to.
Oh, game changing. Now when we discovered this butter a couple of years ago, like everything in our home changed.
Yeah, that's why you got to bake with it.
Kerrygold, what is that? Plugra? Was that like, isn't that like Austrian or German? Yeah, all those European butters.
You know you're special if you come over to the Steinbeck house and we take out the Kerrygold. Yeah. If we just break out the normal butter.
Steinbeck household and they gave me nothing.
If you just break out like the normal butter. Like, you're not special.
The Trader Joe's butter.
Yeah.
That's all I know.
Kerrygold is the good stuff.
All right. It's time to say goodbye.
Oh, it's time to... I thought we were talking about butter, guys. I'm sorry. That is going to do it for our cross-platform coverage of the market close. For all the latest butter news, you can check it out at Bloomberg.com and on the Bloomberg terminal. We'll see you again tomorrow, same time, same place.
Of Kerrygold.
All right, our coverage continues here on Bloomberg Television. A look at the middle market and what to expect in the second half. A special conversation coming up after the break with Lawrence Golub, the CEO of Golub Capital. That's coming up next here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. It was an interesting day on Wall Street because we came into today with some relatively encouraging data on the economic front. A CPI report that, while it did show an increase in overall growth in inflation. It was a little bit subdued, and there were certain pockets of it that were actually a little bit more encouraging. You also had some relatively decent earnings reports out of some of the big banks, but you put it all together and you still had a market on edge, concerned about tariffs, concerned about economic conditions, and maybe not quite believing everything coming out of some of those executives' mouths about how they see the next couple of quarters. You did see a spike in yields on the day, and that was largely a function of the idea that investors are now starting to price out some of those rate cuts that they had priced in. The 30-year yield now at that 5% level, and on the short end of the curve, you're now starting to flirt with 4%, and that had a huge impact on sentiment in the equity market. The dollar having one of its strongest days in quite some time. And take a look at financials. I mean, given the big moves we saw in Citigroup and JP Morgan, to see them as a group, Scarlett, down 2% on the day, what was that telling you?
They had rallied into the earnings season,
Yeah.
so maybe there's a little bit of pulling back afterwards. You mentioned investors being on edge, and that's certainly what we saw with Newmont Mining. The gold miner said its CFO resigned and it's seeking a permanent successor. Now, a BMO analyst said that this was a surprise and raises a lot of questions until the company reports earnings on July 24th. So we'll wait to see how that shakes out. NVIDIA and AMD were the star performers today, helping lift the tech sector in the S&P 500 overall. Both companies saying that the U.S. government is giving them permission to resume sales of some AI chips to China. This is a sign that the recent bilateral talks between Washington and Beijing is opening the door to some trade between the two countries. And Trade Desk up about 6.6% on the day. The advertising tech company getting a big boost on news it will be included in the S&P 500 effective July 18th, forcing passive investment funds to buy shares of the stock in order to keep pace with that index. Now, our top story this hour is what Romain mentioned earlier, the latest consumer inflation print, failing to ease Wall Street's tariff fears. Bonds stumbled, sending the 30-year yield to 5% for the first time since June. Traders are now focusing on the potential for tariff-driven inflation further down the line. Later on this hour, we'll speak with Thea Jamison of Change Global on what kinds of opportunities outside the U.S. the tariff tensions may create, and also get a state of the consumer with Joe and the Juice's CTO Nicoli Schnack. Romain?
All right, but first, let's get a closer look at what's going on right here, particularly in the middle market. There's been a lot of concerns about the potential impact of tariffs on corporate America. But despite some of that tariff uncertainty, private equity-backed companies are continuing to show some resilience, seeing their 11th consecutive quarter of earnings growth. That's according to Golub Capital's Altman Index, which measures median revenue and earnings growth of more than 100 private companies. I'm pleased to say that the CEO of Golub Capital joins us here in Studio 2, Lawrence Golub. Great to see you.
Thanks, Romain. Thanks for having me here.
On one hand, I'm surprised. On another hand, I'm not. I mean, I know there was so much gloom and doom with regards to how tariffs were going to impact these companies, and I know we haven't seen the full impact of them. But just as we've seen with large public companies, with some of the mid-market private companies, they seem to be holding up pretty well, too.
Well, very much so.
Yeah.
I think what we're seeing in this data, which are actual results from the first 2 months of the second quarter, is that a lot of the doom and gloom from economists about possible recession were really just misplaced. The consumer is very strong. Middle market companies tend to be consumer driven. We've got unemployment at 4.1%, average wage growth going up almost 4.5%. And I think another thing that really we all may not have put enough emphasis on is just how much good comes out of getting this tax bill behind us and getting clarity on that. I mean, really, you can almost look and see when the House passed the tax bill and it looked like it was going to recover a change in consumer confidence.
There are provisions in that bill that, of course, are going to benefit private equity from the investor side. Are some of the provisions in that bill also going to benefit your companies, meaning your sponsor companies and the companies you're invested in?
Well, sure. Yeah. I think, first of all, clarity is great. And there were a lot of moving pieces of this bill. Most of the tax provisions related to corporations and companies and PE-backed companies in the United States are really just keeping the tax law the way it's been.
It was since
and keeping the corporate rate where it is, restoring the accelerated depreciation that was just starting to get phased out. You can see already in the energy sector, in electricity, in data centers, that the clarity from depreciation, the clarity from the tax rates has really caused a boom. Where it hasn't yet is there's still a lot of holding back on decisions in the manufacturing sector, waiting to see what happens with tariffs. That uncertainty is still hanging out there. It actually is a plus because it probably will get sorted out over the next quarter or two.
Well, we'll see. We've been saying that for the last quarter or two as well. So.
Well, I mean, I think it relates also to your comments on the CPI. The CPI is not as informative right now because of the tariffs as it might normally be. You get a one-time adjustment in prices with tariffs, and that is reported in the CPI, but it's not persistent inflation. It's if well handled, is really just one-time inflation. So we need to look more at the underlying economics rather than GDP or CPI, and you look at things like consumer income, you look at things like no increase in delinquencies on credit card debts, no more write-offs, and those are pretty bullish indicators.
So when you look at these middle market private equity backed companies and you look at second quarter revenue growth of 2.3% and earnings growth of 5.4%, extrapolate for us what that means for the publicly traded companies, the public companies.
Okay, so an important limitation to that extrapolation is that almost all these businesses are U.S. companies selling goods or services to U.S. customers. And so it's going to be a little more U.S. centric than thinking about a multinational company. Now, the dollar has also weakened. That's going to be a plus for multinational companies that are reporting in dollars. I think that the increase in margins that we've seen surprised us favorably a little bit. We expected resilience, but there's been a continuing ability on companies to maintain cost controls. And I think that may well carry over into the larger public companies, particularly the ones that are in a profitable stage of development.
I am curious as to how you sort of pick what you want. I mean, I know that Golub was involved in investing in Crumble. This is the cookie chain that's somewhat faddish. And it's one thing to invest in a consumer product that will stand the test of time. It's another to invest in something that may be here today and gone tomorrow. So how do you make those decisions to make sure that what you're investing is not only profitable, but it has some staying power?
Well, you sound like you were at our investment committee for the Crumble deal.
Is this it? Yeah.
No, this
Am I the counter argument?
There were arguments on both sides. Some deals are absolutely easy. And we only invest in companies that we think have a low risk of getting in trouble and a high likelihood, even if they get in trouble, that somebody will want to buy them. The way we got over the finish line on Crumble is it's a franchisor. It has steady profits from franchising. And yes, I think we absolutely are concerned about a certain amount of the faddishness in our models. I think the company's going to do great. I think the equity's going to make a lot of money. But that's not how we model it. We model it to see how bad it can get, and we still do okay. And it's important that there be a real margin of safety there, because yes, we want to make sure we get paid back. We also want to be a good partner to the private equity firms, and we need to be resilient, flexible, long-term with that. So you did good research. That was not the easiest one ever. But it really was looking at the resiliency of what happens if growth rates actually go negative, and the company's very well managed. They've got a strong brand.
So you said something that got my attention, which is that you're surprised by how profitable the companies have been. Does that mean that we're not at peak margins?
Well, I think that in some sectors, we're absolutely not at peak margins. So let's take business-to-business enterprise software, where there's been meaningful cost pressures. There's been customer acquisition cost pressure that's been going up over the past couple of years, and margins have not stayed as high as they were 2 or 3 years ago. I'm no AI expert. I wish I were smarter at how to use it in our business, but the software development costs are going down. And I think we could see some recovery back to higher levels of margins. I think on consumer products companies that have been import dependent, we may be at or past peak margins. They're going to end up absorbing some of the tariff costs, and there's going to be a good amount of time to adjust to that. That doesn't mean they're past peak profit. It just means that the growth rate in margins has some headwinds.
Got it. Lawrence, always a pleasure. Thank you so much.
Thank you.
Lawrence Golub, CEO at Golub Capital, with his take, his insight on the profit picture here for middle market private equity backed companies. Coming up, NVIDIA and AMD finishing the day higher as these chip makers plan to resume AI chip sales, or at least some of them, to China. We've got more on that story next. This is A Close on Bloomberg. Time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Noah Wyle. This is the actor receiving his first Emmy nomination in 26 years, earning a nod for his work on The Pit, which of course remain. Recalls his breakout role as Dr. John Carter on ER in the 90s, a critical Chicago-based show.
Wait, I'm confused. So the pit, it's set in an emergency room?
Yeah, but in Pittsburgh, not in
Pittsburgh.
Chicago. Yeah,
And
different
the
hospital.
last time that he got nominated for an Emmy was?
Probably back in ER days.
ER.
26 years ago.
Okay, well, if his agent's watching, I think we see a trend here to his future success. I'm keeping an eye on the Chainsmokers. This is a musical duo that they co-founded a VC firm back in 2019 called Mantis, and it just had its latest funding round, its third funding round, raising about $100 million. This was a surprise to me. I was really surprised. I don't know, it must have been 2 or 3 years ago. I was at an investment conference, and the Chainsmokers were there giving doing a panel, and I thought,
not doing a
and I thought,
performance.
why would the Chainsmokers be at an investment conference? But it turned out they're pretty prolific. I think over the years they've raised something over $200 million for this fund and made some pretty interesting investments along the way.
Yeah, and actually, Alex Paul says that the band is much more hands-on than the average celebrity VC.
Oh, yeah, yeah.
And how he spends most of his day working on the startup strategy, and only does he focus on his music. At
night. Yeah. They're not just figureheads. They're knee deep in it.
He's figured out the work-life balance. All right, third on the docket is Jensen Huang, the NVIDIA CEO, officially passing Warren Buffett as the 9th richest person in the world. This is according to the Bloomberg Billionaires Index. Yeah, number 9 is Jensen Huang. $143 billion is his net worth. And so far this year, his net worth has gone up about $28.7 billion. All
right, well, speaking of Jensen Huang, there was big news today involving NVIDIA. This after we learned about plans to resume for the U.S. to allow the resumption of some AI chip sales to China. Now, this would mark a major reversal for the Trump administration. Mike Shepard joins us right now, who leads our technology and strategic industries coverage out of Washington. And this was a bit of a surprise, Mike. I mean, there's sort of been a flip-flop and then another flip-flop and now another flip-flop from the administration on exactly what companies like NVIDIA, AMD, and others are indeed allowed to sell to China. What are they allowed to do as of today?
Well, what this allows them to do is resume sales of certain AI chips to China. It's not their most advanced stuff. When we talk about NVIDIA, everybody focuses on the Blackwell chip. It's the latest in their product line, and it's the one that they are really trying to sell to the American hyperscalers. We all know who they are. But they have tailored previously to meet earlier export restrictions imposed by the Biden administration, the H20 chip. Now, when the Trump team came in, they took a look at that and said, now, you know what, selling that, even though it's tailored for the Chinese market to meet those earlier export controls, that still poses a national security risk. So we're going to put the kibosh on that. Now they have walked that back. And part of the reason is Jensen Huang is arguing, and has done so successfully apparently with the administration, that keeping his company out of the Chinese market actually hurts U.S. competitiveness abroad. His case is that, look, if we are not able to compete in China and sell our goods in China, which is, Romain, by the way, the world's largest market for semiconductors right now, it will just give that space over to Huawei Technologies, which is NVIDIA's top Chinese rival. And that would allow that would allow Huawei, to springboard to other markets around the world. And that is the last thing that NVIDIA or the Trump administration wants to see, hence this reversal.
Yeah, and of course it speaks to the lobbying prowess of Jensen Huang as well. He was at the White House last week. I believe he's in China right now, so he's able to play kind of a go-between, a very effective go-between between the two countries.
Well, that's right, Scarlett. And it's interesting. He has had this kind of interlocutor role, informally perhaps, in being able to travel between both capitals and have meetings with senior officials in both countries within days of each other, and they all give him an audience. And he makes a persuasive case wherever he goes, and it's something that both sides want to hear. China is eager for those NVIDIA chips to help boost its own AI ambitions, and Donald Trump certainly has tried to embrace what Jensen Huang is bringing to the U.S. He has previously heralded investment and spending plans by NVIDIA in the U.S., and this is something that helps bolster his own AI agenda as president.
All right, good stuff. Bloomberg's Michael Shepard, thank you so much joining us from Washington. We've got much more coming up on The Close, including a conversation with Thea Jamison on emerging markets. This is The Close.
All right, welcome back to The Close, a focus on markets and a focus on emerging markets as trade tensions ease on a few fronts today. A new trade deal, at least that's as Trump bills it, with Indonesia. And of course, maybe a potential breakthrough when it comes to the ability of chip makers here in the U.S. to sell some of their wares to China. You put it all together, and you do have a market here in the U.S. that is decidedly focused on the globe, particularly emerging markets, with an emerging markets index right now, 7 months into the year, far outpacing the gains that we're seeing in the S&P 500. Joining us right now to talk a little bit more about this is Thea Jamison, the founder and managing director of Change Global. Great to see you.
Good to see you, Romain.
Let's start with the outperformance we've seen in EM this year, because that was not by accident. You had a lot of people come into this year, and I think some people were coming in with a big bet on staying overweight the United States. But there were a lot of reasons that unfolded over the last few months that gave people a reason to think about diversifying, and they really did seem to embrace it. Do you think that's going to continue into next year?
Absolutely. We're so excited about emerging markets today. This is really the first time in about 10, possibly 15 years since the global financial crisis that the stars are aligning. And I think one of the drivers is the dollar direction. Just to give you a sense, this year, emerging markets are up approximately 17%, of which a quarter is coming from gains in the local currencies. So this is pretty significant. It could have an impact on positioning going forward, but also it could have a very, very meaningful impact on the way the economies could be managed going forward.
One area that everyone has talked about, both in terms of emerging markets as well, to a certain extent, developing markets, is the renewed interest in Europe writ large, particularly with maybe the potential loosening of fiscal constraints, as well as some other developments that have, I guess, created, on a relative basis, a more attractive opportunity?
Yes, it is very, very interesting, and I'm glad that you're asking about Europe, because it's one of the regions that we're most excited about. I think that we have all heard about the fiscal infrastructure, defense spending, but what we're not quite hearing about is the incredible focus on the local capital markets. And that is something that was spelled out under the Draghi plan. This year, the German administration is taking it to heart, and they're promoting the development of the local stock markets. Some examples are an attempt to shift liquidity from the banks. The banks are very, very liquid into the local stock markets, but also consolidate the regulatory legal framework to facilitate investment across 27 different countries. I would love to share Euronext just 2 weeks ago announced an intent to acquire the Athens Stock Exchange in Greece, which is certainly a step in that direction of uniformity.
And these investment themes have little to do with tariffs or the threat of tariffs as well, right?
Yes, so these are themes that have been unfolding for quite some time domestically. And that is because emerging markets have gone through a very adverse period over the past decade that had everything to do with these relentless flows to dollar-denominated assets. And given that adversity, incredibly high real rates is another driver going forward, emerging markets had to look inward and implement reforms to improve the domestic environment.
The last time emerging markets were this popular was when China was kind of at the center of it. How does China fit in now to someone who's looking at the emerging markets?
China, of course, is very important, and it's important for the global economy overall.
But as a destination for where you want to invest in?
Absolutely. So there are many, many options besides China, but China is an important market within emerging markets. And in our approach, we look to globally diversify across all regions and countries that have compelling internal domestic environment. The situation in China, I was recently there, seems to be stabilizing from a macroeconomic standpoint. The government is doing quite a bit to help the wealth effect through the stabilization in the real estate market, as well as the recovery in the stock market. This year, perhaps the biggest change in China is the reestablishment, if you will, of Hong Kong as a global financial hub. There's over $35 billion in IPO proceeds that have been raised in Hong Kong this year, easily number 2 after the US, and a very, very high-profile listing of CATL, the largest lithium battery producer globally.
It's interesting, too, when we talk about trade policy out of the U.S. and the trade war, whatever you want to call this, and tariffs. Obviously, China is directly affected by that. But given its size and its importance as an economy, it's obviously found some ways to navigate that. Let's go to Latin America, where you're talking about economies still sizable, but nowhere near the might that China has. And I am curious that when you look at Brazil, or you look at Mexico, or even look at some of the other countries in South America, how do you think they are going to hold up economically if indeed the tariffs that the U.S. is seeking to impose are indeed imposed?
We're actually quite excited about Brazil. Brazil is a domestically oriented economy with a very diversified sector base: agriculture, consumption, finance, transportation. Exports to the U.S. are fairly insignificant within the entire picture. But we're excited because Brazil has incredibly high real rates at a time when we have dollar stability, which will potentially unleash the central bank to help ease monetary conditions.
Do you see any chance, particularly in Latin America, that you will see some of those countries band together a little bit more with regards to trade and economic policies as a potential pushback to whatever deterioration in the relationship with the U.S. is?
It is absolutely possible. We have seen an intent to trade amongst each other, the so-called South-South corridor, unfold for several years now. And in fact, there is a terrific statistic. At the start of the century, the developing world was only trading roughly 23% of its exports amongst each other. Now that ratio is closer to 46%. So that is a development that's taking place. It has to do with better infrastructure. It has to do with better framework overall.
I got to ask you about the Middle East as well, because the president was there not so long ago, and there are a lot of deals announced, particularly when it comes to chips and AI. And it all speaks to this idea of a lot of those countries, those kingdoms, really diversifying their economies away from energy. Talk a little bit about the specific opportunities you see there.
The change is absolutely unbelievable. I've been traveling to the Middle East for 15 years, and I have seen tremendous evolution. The economies are opening up, they're diversifying. As an example, Saudi Arabia is now open to foreign investment on the stock market. But just recently, last week, they also announced that they will selectively allow foreign investors to own real estate in places like Jeddah and Riyadh. So this is a phenomenal change. The UAE probably has the best example of a successfully diversified economy, and AI is going to be a big driver for the economy going forward, with the biggest AI data center outside of the US being built as we speak in Abu Dhabi.
Yeah, and big customers of those American chip companies as well. Thea, thank you so much for joining us today.
You're so welcome. Thank you.
Thea Jamison is founder and managing director of Change Global. All right, let's take a look at how markets closed on the day, Romena. We ended up losing ground, although in the initial early minutes of the trade, it did look like that tame inflation report would give us a bit of a boost.
It does seem like a lot of this, at least a lot of the down arrows that you saw today, were directly tied to a repricing of the Fed. The idea that you had coming in today, people really thought we were going to get 2 rate cuts this year. The pricing only moved slightly, but it's less than 2. And more importantly, people are starting to price out the chance that we get that first one in September. And maybe that's why you saw people looking at some of those multiples and some of those valuations and saying,
maybe not right now. Yeah, and that's why the 2-year yield moved up 5 basis points. You definitely saw short duration treasuries underperform longer duration treasuries, and that's kind of a flip from what we've seen in the past. Chip makers, though, continue to be the winners.
I just want to say 1.6 right now. We're just rounding up on a JGB 10-year Japan.
I know, that's nothing on its own.
But it's nothing on its own, but we know where it used to be. And I just harken back to the conversation we were having yesterday with Amy Wu Silverman, who was talking about this idea of complacency heading into the summer. And of course, what we saw August 5th last year, where that carry trade blew up because, well, a lot of stuff went wrong and everybody was at home. So that sort of exacerbated the moves.
So keep watching that one. It's at the highest since 2008.
This is the close on Bloomberg.
A tall order ahead for juice and coffee cafe Joe and the Juice. The company is expanding its partnership with fintech platform Adyen to make its payment experience frictionless for customers. For more on what this entails, let's bring in Nicoli Schnack. He is the CTO of Joe and the Juice, joining us from Copenhagen, and Davi Strazza, President of North America at Adyen in San Francisco. Nicoli and Davi, thank you so much for joining us. Nicoli, let me start with you. You are now combining payment, marketing, and loyalty features in a single countertop device. Walk us through how your customers would experience that. How do they go through that? How does it enhance their experience?
So I think taking a step back, in Joe and the Juice, we are producing freshly made juice, sandwich, and coffee. And we want to bring that at a convenience. And one of the ways we do this is with our loyalty platform or app, which is something we're integrating seamlessly into the brick and mortar stores with Adyen. So the new terminals that we are focusing on today is enabling us really building that connection, making it seamless for the customers. And this is something we're building not already today, but also something that's coming in the future.
So Davi, from where you sit, what specific problems does this solve for a company like Joe and the Juice?
Absolutely. Look, if we look at the commerce world and how it's evolved over the years, a lot of technology has helped e-commerce companies evolve fast and offer a seamless user experience, but the same hasn't happened in an in-store environment. And so we made it our core mission at Adyen to ensure that businesses like Joe and the Juice that operate across online environments, in-app environments, and stores, physical locations, could connect both worlds, learn more about their customers at the point of sale, engage with them, but also offer a great experience. And so it's really easy to navigate those channels for a consumer, and for Joe and the Juice and other businesses alike, it's operationally very efficient to do so.
So I am curious, though, Davi, how much information is actually being shared with Joe and the Juice? So if I go in and I either swipe my card or tap my phone there, are they able to get all of that information, or is all of that routed first through your payment system?
Look, the answer really depends. Depends on geo, depends on the integration that a customer would have with our systems. But ultimately, what we do is we help connect both worlds. And so you can imagine that customers, they have different preferences, and some customers prefer to shop in store, other customers prefer to go online. What we see today is that for many businesses, it's difficult to understand what's going on. And so oftentimes when a customer shows up online, they're treated as if they are shopping for the first time with a brand, even though they might have been shopping in store for several previous times and temps. And so in our system, we are able to kind of identify all of those interactions. We go back to Joe and the Juice, and we can tell with confidence that that shopper that is going to their e-commerce for the first time has been shopping in store for multiple times. Yeah. And so we connect and offer them the data to offer a good experience to that shopper.
So Nicoli, I can easily see why this is a potential benefit to Joe and the Juice. Can you articulate what the potential benefit is for consumers? And I don't necessarily just mean the loyal folks who come in there, every day or every other day, but maybe newer consumers who maybe either haven't experienced a brand, or maybe they only pop by, once in a blue moon.
For sure. So I think the way we're leveraging the terminal, it is much more on actually enabling the customer journey to the app. And that is because if you're coming by one of our stores, you're trying our products, you want to try it again, the terminal allows us to also create efficient onboarding flows. So while you're waiting for your products, you can join the loyalty program, and that enables you to pre-order Joe at convenience in a future time. And I think for the terminals and the data we get, it's not just about the data you're giving to Adyen. I think it's much more for us to onboard customers to the loyalty program that we have, to enable the customers to try a journey that they wouldn't otherwise try.
Joe and the Juice is based in Copenhagen. You obviously have a presence in a lot of U.S. cities, and I'm curious, Nicoli, if you can tell us a little bit about how this technology supports the your expansion in the U.S., and how consumer behavior in the U.S. differs from, say, in Europe, and how you see that evolving.
So the partnership with Adyen started almost 10 years ago, and we did initially a project with Adyen to streamline our business to have the same payment setup across the world. This has enabled us customers today to basically join the app and use that everywhere in the world. But coming from a European standard, it's obvious that there are differences to how you do payments in the US and in Europe. This comes down to the small flows such as terminal sizes. This is really what we enjoy with SFO1. It's fitting the US standard, where we are seeing more of a marketing use case for the terminal, making sure that the transaction is not just a friction, but it's also a way of communicating with your customers. this is something that's definitely U.S. driven, and that's something we've seen in Europe historically.
So, Davi, I do want to get your thoughts before we let both of you go here, just about broader economic conditions. And obviously, as a payments company, you certainly have some very direct insight into that. When you hear talk in the media or talk on corporate conference calls about potential softness in consumer spending, are you seeing any credence to that? Are people pulling back? Are they spending the same amount? Are they spending at the same volume? What?
You're right. Like we do have an advantage point from that perspective. We processed $1.34 trillion in payments last year across all geos. And so it's really interesting to see what that data reveals. What we see is that consumer spending in general has stayed resilient, even though like consumers are being much more selective in terms of what they buy. I think what that makes is that for businesses, they have to ensure that when the consumer is ready to buy, there cannot be any friction. It's really critical that the shopping experience is critical, and that manifests in different ways. In the store environment, investing in mobility, in-app purchases like Joe and the Juice is doing right now. For e-commerce, is investing in having the right payment methods available at checkout. One way or the other, for a business right now, you don't want to take your chances. If a consumer can't pay the way they want, they will walk away, and more often than not, they don't come back.
All right, guys, I really appreciate both of you taking time. Obviously, strengthening of this partnership that dates back for the last decade. Davi Strazza, president of North America at Adyen, and Nicoli Schnack, Joe and the Juice, CTO. When we come back after the break, we're going to set you up for what to watch over the next 24 hours, and that includes another read on U.S. inflation. This is Bloomberg.
So today's CPI report, a mixed bag. Core inflation rising, but less than expected thanks to softer car prices. Investors and economists looking ahead to producer price data tomorrow for a fuller picture ahead of the Fed's July 30th interest rate decision. Stuart Paul of Bloomberg Economics joins us now. So you look at the headline numbers and they're not discouraging, but on a line-by-line basis, they're not encouraging either.
That's right. I think that most folks were focusing on the 0.2% core that we saw today. The month-on-month core CPI print came in just a touch below expectations. And maybe some folks breathed a little bit of a sigh of relief. Maybe the Fed could start or resume interest rate cuts. But the reality is a lot of the details of today's report were exactly the opposite of what the Fed wants to see. We saw accelerating prices for things like household furnishings, for other durable goods, including appliances, electronics, non-durable goods, including clothing. A lot of the imported goods that are subject to tariffs that the Fed is worrying about, those are the goods that were subject to the largest price increases.
You certainly saw that. I would argue you had to squint a little bit to find it. I mean, for those of us who aren't trained economists like yourself. But it gets to the idea as to when we're going to see more of an impact. And I know with PPI, there's been this sort of parlor game as to, look, we know we've collected, however, $100+ billion in tariff revenue. That's coming out of someone's pocket. So either the companies are eating it or they're passing it on to the consumers. Are we going to see this show up in the PPI, if not in this month's report, the next month?
I expect that we are going to see some inflation pressures in PPI. I think that we're going to see a headline print of about 0.3% month-on-month, core of about 0.2%. This is what's a little bit tricky, is that everybody is waiting for tariffs, but the real ball game for this week's PPI print is going to be financial services prices, portfolio management fees in particular.
They're not raising their fees, are they?
Well, when the stock market does well, when the stock market does well and portfolio balances rise, that 1% wrap fee represents relatively more money. And so you end up seeing a knock-on effect in core PCE inflation rippling through after PPI prices come just this week. So when we do our mapping based on today's CPI and what we expect for PPI, we're expecting the Fed's preferred price gauge, the core PCE inflation measure, to register about 0.3 to 0.5%. That's a
sizable jump.
That's a pretty hot core PCE reading.
You know, if I ever get reincarnated, I want to come back as a management fee.
Not in the ETF industry, unless you're an active ETF. Yeah. All right. In any case, how does this set us up for the Fed meeting at the end of this month, July 30th? Of course, people have been pricing in 2 to 3 rate cuts, more recently close to 2. But, you know, today's data discouraged people away from that idea. there's a lot of data to sift through, but that core PC number doesn't come out until the day after FOMC.
That's right. Core PC comes out the day after FOMC. The last big data point that we're going to get before the Fed meeting is going to be Q2 GDP. But given how lagged that is, given how much folks have had time to digest what's been going on with broader macroeconomic activity, is probably not going to sway the Fed from staying on hold. In fact, the next meeting that matters is really the September meeting, where right now it's, just under 50% odds, I think, that the Fed's going to end up cutting in September. And frankly, going into the Fed's meeting, the fact that the unemployment rate ticked down, again, just solidifies the fact that they're going to remain on hold.
All right, Stuart Paul of Bloomberg Economics, a nice preview of the economic data up ahead as we push forward to what could move the market over the next 24 hours, and that includes, Scarlett, some earnings, more bank earnings before the market opens tomorrow.
Bank of America, Morgan Stanley, Goldman Sachs will be reporting, and if you look at the bank stocks and how they did today, within the KBW Bank Index, Citigroup rose, everyone else declined.
I always love the commentary out of those big banks, a good read on the economy. We're also going to get Johnson & Johnson in the morning, a critical component here of what we might see in the healthcare space. And then after the bell, we get some big ones, United Airlines amongst them.
United Airlines will be reporting, Kinder Morgan from the energy space, and Alcoa as well.
All right, on the economic front, we are going to get the MBA mortgage application data. Expected to see an uptick in that. 8:30 a.m., we do get that PPI data, but 2 p.m., Scarlett, we get the Fed Beige Book, which I know is, by its title, is not necessarily always scintillating, but maybe we get a little bit more insight into how folks are feeling out there in the various
Absolutely, and Jay Powell has made clear that they are looking more closely at things like that to kind of get a better understanding of how consumers are responding.
And I know you love Fed Speak, Scarlett, only 3 days before they have to go into a blackout period, so
wow.
They are talking
Get
and
it
talking
all
and
in.
talking.
Get it all
Hammett,
in.
Barr, Williams, Barkin, all set to speak tomorrow. We'll have full coverage on anything they say that does move the markets right here on The Close, right here on Bloomberg.